So we're going to continue this conversation with someone who knows the labor market in particular very well here, zeroing in on that JOLTS data, because we've got Seth Harris here. He's the former acting labor secretary and Northeastern University distinguished professor of practice in law and policy. Seth, it's great to speak with you. So let's start on that JOLTS data in particular here. I'm curious from your perspective, kind of in line with expectations, but we are seeing a bit of a market reaction. What stands out to you?
Well, what's been most striking about the JOLTS and also to some extent the employment situation reports that we get from the Bureau of Labor Statistics is how boring they are. And that's what you want in the labor market. You want, just like an airplane trip, you want it to be smooth. You want it to be boring. You don't want any excitement. You don't want a lot of turbulence, and you want to land very gently. And that's essentially what we're seeing in the labor market right now. There are some indications, some sort of gentle turbulence that we're beginning to see in some of these numbers. I worry about the quits number, the number of people voluntarily leaving their jobs going down. That means that workers are not feeling, they're feeling a little bit less secure that if they leave their jobs, they'll be able to find another job. The hiring number going down a little bit, I don't worry about. And the job openings number don't tell us a lot, particularly when they're moving within a range as they have been. So on the whole, the labor market remains really strong, but I combine that quits number with the initial weekly unemployment claims number that we get from the Labor Department and that we'll get on Thursday. That number is higher than I would like. That's something of a proxy for layoffs. And that's an indication that employers are beginning to feel the pressure to maybe let some of the workers in their workplaces slip out of their clutches. Employers have been hugging their employees really tightly. They don't want to have to do job search in a tight labor market. But now we're getting just the beginnings of an indication that with the economy slowing, with interest rates high, that maybe they're letting some of those folks go. So not a crisis, not urgent, but some turbulence that I think we need to pay attention to.
And Seth, when it comes to what we need to be watching for in order, I guess, at what point do you then start to get a little bit more concerned about the softening that we are starting to see, it sounds like, within the labor market?
Well, I would say I'm not concerned, but I would like to see the Federal Reserve take some action. They need to send a signal that they're not just concerned with inflation, but they're also concerned about employment and unemployment levels. So I'd like to see them do a 25 basis point cut. I think it's unlikely they're going to do it at their next meeting, but perhaps in September, just to send a signal that they consider jobs to be a priority and that they see this gentle softening that's happening in the labor market right now.
Would you feel more comfortable if they cut this week?
I would. I'd like to see. I've been calling for it for a couple of months now. I think we have seen inflation come down drastically. It is hovering just 50 or so basis points above their policy target. That policy target is not carved in stone. It's not written in the sky. It is a policy goal. We've seen this steep decline in inflation. I think that they can loosen the reins a little bit. I'm not suggesting 100 basis points or 200 basis points, but 25 basis points to send a signal to employers that there's a little bit of relief coming and that they should continue to hold on to their workers and maybe bump their hiring a little bit.
Seth, what do you think the pace of the cuts is going to look like? If you're suggesting that we will likely maybe get a 25 basis point cut here next, not necessarily at this meeting, but if you look ahead to September, looking further out maybe towards the end of the year and then into 2025, what do you think the pace is likely going to be from the central bank? And then ultimately how you see that playing out or what that really tells us about where we are in this economic cycle?
Yeah, I think that if this group on the Federal Reserve has shown us anything, it's that they are remarkably cautious and very tightly data-driven. So I think that they will look to a cut maybe in September. I think they're going to wait for a couple of more months of data to see whether they should do that cut. They'll give us a small cut and then see what the reaction is, not in the markets primarily, but with respect to inflation and both employment and unemployment. If they see a positive reaction to that, then I think they will begin a plan for more aggressive cuts, perhaps in 2025. But I think that they're going to be very much in a wait and see, measure and react mode.
In terms of what you have looked at in your career, Seth, particularly as former acting U.S. Labor Secretary, I was listening to an analyst this morning talking about how when companies lose on pricing power, they win on earnings by cutting costs in other ways. And of course, a primary method for that is in the form of layoffs or hiring fewer people. When you were in your role as the acting Labor Secretary, to what extent did you listen into those company earnings calls as an indicator of where the labor market was heading?
Right. I never once listened into a company earnings call because individual companies were not really my concern. I was looking at the macro economy as a whole. But, right now, the business community has immense pricing power. Profits are booming in most segments right now. There is some real softness in the housing sector for a whole bunch of reasons. Ironically, part of the reason that the housing sector is as soft as it is right now is we lack supply, and it's very hard to get capital to build additional supply because interest rates are so high right now. So I'd like to see, again, another good argument for bringing interest rates down. But as a general matter, employers or businesses have a tremendous amount of pricing power. And that's one of the reasons why, as the economy slows a little bit, although GDP was very solid in the second quarter, I think that they don't yet have to look to other alternatives. The other thing is that they have to do a cost-benefit analysis on things like layoffs, right? If you lay workers off and then there's a pickup in the economy, and that's what's been happening, we see a little bit of a slowdown, and then we see a pickup in hiring in the labor market. Well, then you got to spend money to bring more workers in, particularly if you have to increase output. So I think that what employers have decided to do is to hold on to the workers that they have to the extent they possibly can, to try to ride it out. They're doing just great on the profitability side, and then see how things develop slowly over time. But we're not seeing the kind of wholesale shedding of workers that you might have expected with the kind of interest rate decision making that the Fed did. That's a terrific thing. It's partly because of the fiscal policy that President Biden and Vice President Harris helped to put in place with Congress. These massive public investment bills have raised the floor on hiring and employment in the United States. That has helped tremendously. But also, I think the Fed has been pretty cautious. I'd like to see them sort of turn their heads and be a little more cautious on the employment side.
All right, Seth Harris, great to get your insight here at the top of the hour, former acting U.S. Labor Secretary. We appreciate you taking the time.